Good afternoon, everybody. Welcome back to the Opportunistic Trader. It's 1 o'clock on October 2nd, and we're joined by Tom McEntee. Tom is a former floor trader, looks at individual equities, options, looks at really good risk-reward opportunities and ways to express them in the option market. He's been joining us each week. He's active in the chat room, really knowledgeable equity trader. Tom McEntee, how are you doing, Tom?
Great, Mike. Thanks for having me. Good to speak with you again.
Yeah, it's great to have you. A lot of things going on. It's Q4, the start of Q4, and market's been pretty active. Yesterday we were talking, we saw huge outperformance in equity in S&P and NASDAQ versus Russell. So small caps were underperforming, and today we're seeing that same divergence where we have Russell down almost 0.75%, whereas the S&P is up small, NASDAQ's up small. VIX is trading down about 2% here. Any general market thoughts?
Yeah, I guess I got just from John Hassinger. Boy, I've still got a pretty good memory. John Hassinger asked the thoughts yesterday. I guess like a lot of people here, I'm kind of bearish on things. I'm not willing to call it top, but I think you can avail you. I mean, you can avail yourself of some cheap stuff in the options market here. I queued up my screen. I'm going to let's put the spiders on it. I didn't do this. I've been looking at it. I've been bidding. I have not gotten filled. Full disclosure. I think optionality is exceptionally cheap. What I'm seeing here is two things. I mean, the market's relentlessly marching higher. Every dip is a buy. The pullbacks are very, very shallow. So I think what you got here is almost a Pavlovian response to any type of red screen, and I think that's kind of mimics the market you had from I would say election day of 16 up until January 22nd of 2018, kind of getting that same reaction, and volatility's following suit. I mean, ideally, 30-day stuff in S&P and the spiders or SPX trading around 9, cheap. I think it's compelling. I think I can make money owning it. Nothing's 100%. I think I can make money owning it. I think it's very, very cheap, and I would dare say almost foolish to not avail yourself of it. I think what you're getting here is, I think this is just an observation, and I think if you jog your memory banks here, I think what's happening here is, to me, and a quick glance of this, and I'm by no means a legal expert or a trade expert, but a quick glance of the trade agreement announced yesterday versus what the NAFTA was before that, it seemed very, very similar. I don't know how much of a difference that makes going forward. But the bigger question, the bigger point to me is, I think that Trump's tweets are losing their efficacy. Trump's diatribes are losing their efficacy. I think it's important to realize, I think everyone's reluctant to be long a lot of these names that he seems to go after. But if we put things under the microscope, he's gone after Nike, which has gone up. I think I'm going to say it was like 81 or 82 after the Colin Kaepernick commercial. I could be wrong by a little bit, and it got up as high as 8. Did it trade 86 the other day? So that's up roughly 5%. He went after I guess Apple, and Apple. No one should go after Apple. I mean, they're taking over the world. We went after crude oil. I think when it was trading 71-ish, that's another 6% on top of that. So I think a lot of Nike, Apple, crude, those are the recent diatribes. Those tweets, in an effort to, I don't know what he's trying to do. He's attacking them, but those stocks are rallying. Now, another thing, and I think in contrast to that, I had the ignominious pleasure of being short letter X back on Feb 16 of this year. Now, only I would notice because I was caught short around the 38.5 level, and the stock ran up, I'm going to say, $6 in an hour and a half, 2 hours. I didn't know what the news was. And the stock got, I think, 44.5, somewhere up in there. Anyway, I'm scrambling. Day's over. And then I think at 5 o'clock comes some announcement that tariffs are being imposed. The reason I bring this up, and I will hit up this chart of steel. Here is U.S. Steel, kind of, where was this? Yeah, this is 2.5 the day of the big, the 100 handle SPX down move. We got as low as 31. And then here is February 16, roughly 11 days later, that Friday, the Friday after the 2.9 bottom. So I guess below that day, we got 38 to 38.60. We got as high as 45. Sorry, I was wrong. 45, 44. I thought 44. Okay. We rallied, got to 47. Tariffs were great. This is going to be a game changer. We're opening up plants. But now what's happening? Is it a company-specific thing? But steel's down, what is it, $29 as we speak? So what's that? So from that pre-tariff low, that pre-tariff announcement low, stock's down roughly, 25% since then. So I mean, I don't know how well long term. I know it is long term. I get it. How well long term the tariffs are working for steel. Right now, it doesn't appear to be such. But that kind of dovetails to what I want to talk about. X got up to $47, I think 47.60. Yeah, 47.60 on March 1. Here we are 7 months later. We're 18, about 40% lower, give or take. To me, if you can see my chart, you can see my cursor here. Obviously, for those out there, I am the information superhighway. It does not have an entrance ramp for me. This low here at 28.50, 28.40 on 8.15. Another low here at 27.90 on 9.11. And then I guess another low here on 28.76. And what's today's low? Yeah. So today's low is kind of pressing that low from 2 weeks ago. My contention, I don't know if I could say this with a high degree of certainty, but it certainly seems like, it looks like to me like a head and shoulder bottom. The kind of bottom I saw on Facebook last week. That said, I'm looking at two things in X, and I think volatility has cratered. If you want to look here, I'll put up this. This is X. So you don't think I'm just making this stuff up as we go along. Here's implied volatility in letter X over the last. This is over the last year. Now it's perking. It's ticking up right now. This is 30-day stuff. It's ticking up right now because earnings are, I believe, November 1. So that's why the 30-day stuff has gone from roughly 35 to 42. I think this stock has, if I go back to the chart over here, I'm looking at this 38. I'm looking here. I think it was 38.80. Is this right? Yeah, 38.90. This high from 724. This low here, 27.74. It's about $11. 5.50. Midpoint 33.30, 33.37. I want to target. We'll call it 33 and a half for argument's sake. I want to target 33 and a half as a cheap earnings, as an upside target, and I want to fashion a spread for earnings around that. So what I want to do is, I'll highlight these stripes. They're in color, so they should be easy to follow. I want to go out to I've got a thing for the January expiration. I don't know. I guess it's new. I want to buy these January 35 calls. You see them here. They're about 97 cents. Okay. And to finance that, and they're roughly about a 27 delta. And I want to sell the November 9. November 9, 33 and a half calls at 55 cents. So the spread, if I pay 90, we'll keep it simple. I pay 95, I sell 55. I'm paying 40 cents for that call spread. It's a 40-cent debit to buy regular way Jan 35s. Regular way is a regular monthly expiration, no weeklies. Versus November 9 expiration, 11/9, like a movie out right now. 11/9 expiration, 33 and a half. Okay, I'm paying 40 cents for that. The delta impact might be about 4, but the beauty of it is I'm selling 45 volatility. As you can see here, the midpoint of this. See, this is the implied vol in the bid, 44.1. The implied vol in the ask is 45.7. Call the midpoint roughly 45. Everybody follow that? I'm proceeding. And in January, I'm buying, I'll just keep it simple. I'll keep apples to apples. Right? If I bought the Jan 33s in Jan, I'm buying 40 volatility. So I'm taking in 4 clicks. And I'm doing the same thing as Jan 35s because the skew is flat. I'm taking in 4 clicks. So the beauty of the spread is I've got time. I want to make time work for me. So I'll look at risk reward. I want to look out to October 31. So this is a couple days, 2 days, I guess, before X reports earnings. The stock's trading at 32 and a half then. So you want to expand your window. I know October 31st is a long time, 4 weeks away. But if we're trading 32 and a half, and they're anywhere between 31 and a half and between 32 and 33 and a half, you're going to make this is 100% return. that spread's going to be you pay 42 cents, you pay 40 cents for it's going to be worth 80 cents. Okay, if the stock's trading at $30, anyway, let's say 9.5 to 31, 29.5 to 31, that spread's going to be worth the spread's going to be worth 60 cents. So you're going to make 50% on your money. These are good risk rewards. Now, on the downside, I would lose 50%. Half the trade, I would lose. The spread be worth 20 cents with the stock at 26.5, between 25.5 and 27. So that's pretty decent risk reward. We get 30. We hang around here over the next month. I can't go tick for tick with it, but I'm giving you a ballpark between 29.5 and 31 by October 31. I'll expand it out October 27 to October 31. You're going to make 50% on your money. Spread's going to be worth 60 cents. You pay 40 cents for it. If we're trading between 32 and 33.5, that spread's worth 80 cents. So that's a double. So that is real good risk reward. And like I said, stock trades down at 26.5. I guess all hope is lost there. You're going to lose 50% of your money. So I think you got compelling risk reward here. You're fashioning a trade around the earnings month, around the earnings, but you're taking in volatility. And you got to realize, hey, we trade on October 31. We're trading up. You do whatever the heck you want to do. Kick it out, roll it up, do whatever you got to do. But now once expiration rolls off, November 9, you've got optionality for another 9 weeks. So even the game is fluid and can continue. But like I said, you could do whatever you want. That's decent risk reward. Now another one. Notice how I pick out all the stocks nobody wants. But
I'm waiting to get to the famous Tesla, which is all.
Oh, we can talk about Let's talk about Facebook first, and then we'll talk about. I want all the garbage. Larry knows what I'm talking about. Garbage is king. Some people make a lot of money trading, buying and selling garbage. All right, let's look here. I liked it last week. I was targeting. I was on with Larry. I was targeting 173. Got the 171. I got lucky. I bought a cheap call spread in there. I bought this. You can check the chat. I bought the 70.75 regular way ARC. I think I paid 85 cents, give or take. I wound up kicking out half of it, like $2. And I got a big scalp in the stock. I sold stock up at 171, 170 spot 99. All those out.
Larry mentioned that on the site.
Right. I would never use zeros. I would never use evens. I'm big on 9s and 6s. 9s, 4s, 6s, and 1s. Never be at 0, never be at 5. So I sold 170.99. I bought 166.61 or something like that. Obviously, way too freaking early. But $4 is $4. Okay, now it's back in here. I still maintain. I like the formation. I think it's a head and shoulder bottom. Nobody likes it. There's so much. I just think that it's unloved. It's as unloved now as it was loved up here, when it could do no wrong in this parabolic rise. My gosh, now it's unloved. I think you're going to wash sellers out here. Markets don't bottom on good news, much like they don't top on bad news. I think this thing is starting to wash out. I think you can fashion some cheap upside call spreads once again around earnings. And what I want to do again, hey, look, when I gave that 173.5 target on Tuesday, I didn't think we were going to be trading at 171 on Thursday. No freaking way. Absolutely. That's just dumb luck. I'll be totally honest with you. If it was anything other than dumb luck, I'd be on CNBC. Okay, so I want to target this level up in here. This is what I've been targeting. This is what I'll still maintain. That's roughly a month ago. But interestingly enough, I believe here, I'm looking over here, 187, 150. This is also this level here, this 180, this 173.58, 173.90 level is roughly the midpoint between this post-earnings high, 188.30, and the post-earnings low of, I think, 158.87, 173.5. Okay, that's a long-winded way of getting to my point. Point is this: I think Facebook options are going to take on the same look as what you just saw in letter X. Let's hope I'm not a liar. Let's see. Note how it turns up. Why is it turning up? Because this is volatility. Why is volatility turning up? Volatility is turning up because earnings are coming out, I believe, on OC 30. Do you see that? I think it's OC 30. AMC OC 30. So that's 4 weeks from tonight. Okay. What I want to do is I still want to target that 173.5 level, but I'm cognizant of the fact that it might run through. Does that sound crazy with the stock here? That it might run through. towards that end, I want to leverage the earnings tenor, November 2nd expiration, by selling that. So let's go here. I want to fashion something. I think the stock can get to 173 and a half. It may go higher. But let's look at 173 and a half. And I want to do a cheap spread around this thing. So what I found was this. I want to sell. Do you see what I'm focusing on? The November 175, November 2nd expiration. Okay. I want to sell the November 175 calls. I can get roughly, we'll say $2.10 for those. You see that the 208 bid at 218? Okay. And to finance that, I'll go out to December. And I want to buy the December 280 calls. And that's essentially going to give me, it's going to be a very, very flattish or even probably a zero delta call spread. It's zero delta because the volatility in the November options is inflated, and for good reason, because of the earnings coming up. So I can fashion a spread. I can pay, we'll say $2.90. I can sell them. I can pay $2.95, sell them at $2.10. I'm paying 85 cents. Okay, pay $2.95 deck 80s. Sell 210. I can do a little bit better, but sell 210, 175. Everybody sees that. The vol in the deck 80s is about a 30. The vol in these deck 75s is a 35. And just to keep apples with apples, the vol in the deck in the November in these 80s, November 80s, is still 35. I'm taking in 5 clicks. Now, when I do, this is a class for another day, but I can walk you through it. It's important to know. I mean, this might be advanced, but if I can get it, anyone can get it. You want to know it. What volatility are you buying that time spread? Now, it's important to keep apples with apples. So what you do here is, I would say, I'm paying 35 volatility. I'm selling 35 volatility here. I'm buying 30 volatility in the December 180s. So let's look here. I want to look at this is what I want. So just take me. I don't know where to look here. I have it here now. I lost it. What I'm looking at here is I'm buying that. If I buy that 30, and if I buy 30 volatility in December, and I sell 35 volatility here, I'm essentially buying that call spread at about 26 volatility. I'm so a little bit less, 25 and a half volatility. And I look here, and that's kind of right in line where volatility's been in the stock over the last 52 days, 52 weeks. Let me get this out of the way here. So I'm buying 32. So I'm buying 26 volatility. Now, the way this breaks down. So I'm going to buy the December 7th, regular way deck 180 calls. Sell November 02 expiration 175 calls. I'm paying 85 cents. Okay. Let's look at 2 week. I'm going to look at a 2 week chunk. All right, because we got 4 weeks till the big event, till earnings come out. On 10/17, with the stock at 168. This thing's up 100%. So you pay 80, what did I say, 85? The spread's worth $1.70. Now you got to read. It's not like buying a stock at $45. You're paying 85 cents. So you got to realize the leverage that's inherent or embedded in these strategies. We can go a lot of ways with these. Okay, the stock, you've got room essentially on this spread. You're profitable on October 17, 2 weeks from now. You're profitable from 152 and a half to 181. You got about $28 of room, so to speak. I like that word. You lose half your money at 144. You got room between 152 and 152 and a half and 181 where you're profitable between now on October 17. Now that's compelling. If I'm targeting 173, you're going to lose half of it at 144 or lower. Okay, at 168 on October 17, you're up 100%. Cheap shot, 85 cents. Take a look, see what happens. Stock begins a slow grind, frustrating a lot of people out there, which it probably would. Now you got a game, and then you can, and obviously all of these strategies are fluid. All of these strategies continually evolve as the situation changes. Like, a lot of times stock goes through your strike. Well, I don't want to be, if I'm expressing a bearish viewpoint, like I am in Caterpillar, for example, I don't want to be long in the money calls against short stock. I want to be long out of the money calls against short stock. Conversely, if I'm expressing a bullish viewpoint on something, I don't want to be long in the money puts against long stock. I want to be long out of the money puts against long stocks. It's only because so as if I'm lucky enough to have this stock rally, my strikes are constructed, roughly 10% away from current stock price. If the stock rallies hard, I would roll up and just continually roll up and take a credit. All of a sudden, you've got a new spread on for free. I hope that makes sense. Both of those trades, X, FB, cheap shots, and you can get decent return with not much happening. Now, you wanted to speak about something else, Mike. Go ahead. I'm out of breath.
Yeah, take a second, grab a sip of water. I was talking Tesla. We were speaking about it this morning. Obviously, hot stock, traded down into the 70s. It's had news all over the place. Pops back up to 310. It's now down 477 on the day at 305.80. The range on the day has been about $14. What do you see in terms of? I know you were trading it a week or two ago. Are there any sort of opportunities? And right now, I guess even the short-dated stuff, they probably have Friday expirations. Where's the way out of the money stuff? There's probably, if you have a position, ways of financing it.
Sure, but I'll give you my viewpoint of it, and then you can give me a specific. If anyone's got an opinion one way or the other, I'll give you something. But what I look at when I see this chart, I think two things reach out to me. I see this low here back in whatever that is, 4.4, 251, 9.7 a trade. That was a couple of weeks ago, right? 252, and then last week, big gaps lower, obviously, and now all of a sudden the reversal here was very, very hard. As mentioned before, we talked about put skew in Tesla, and let me hit this up for you. Okay. That's actually a great question, Mike, because I think we can do right by people here. Okay, here. This currently right now at the money. This is a 52-week average in Tesla. Okay, this is a 25 delta put. Typically trades around 50 volatility. You see that roughly, and a 25 delta call typically trades around 43 volatility. Difference, roughly 7. Okay, currently it's 11. Now I would also look at. It's 11 on at the money vol of 58, which is roughly about 18%. 18%. Now it got as high as you can see down here on 9/7. That was the day it traded 270, I guess. So yeah, I'm sorry, 252. The spread was 18 on 63, which is about 28%. So it was really the spread really blew out. Point being, now there are still compelling opportunities to sell downside puts, 25 delta downside puts, and buy 25 delta upside calls. There's overwhelming. It's not as compelling as it was, say, 2 or 3 weeks ago, but it's still there. So, if you just came into it, if you dropped down like the late David Bowie's may have fell to earth, you just fell into earth right now and look at historical norms in this equity, you'd say, wow, this skew is a sale. This skew between a 25 D put and the 25 delta call is a sale. So let's go out to October 19th. Now, what you're doing here essentially is, and we'll find, here's the 25 delta put. You see that? It's the 282 and a half. You see that, everybody? Yeah. Roughly $6.30. Okay. So you can sell that put for $6.30. And I want to buy the 25 delta call would roughly be somewhere a hybrid between these 330s and 335s. You probably wind up paying about $4.70 if my math is right, merging these two. $4.70 on the 330s. Okay, so you'd be buying you'd roughly be buying the 331 calls synthetically, essentially, and selling a 282 and a half puts synthetically. You pay $4.70 for the calls. You sell the puts at $6.30. You're taking in $1.60 on that. Now, what you could do, if you did that one time, you sell 100 shares of stock. All right. Now, what that does essentially is you are synthetically selling the call spread. Okay. You're synthetically selling the 282 and a half by selling the 100 shares of stock against one put. Okay, you're selling. You say, where's the stock right now? 306, right? 306.16, 306. If I sell the stock at 306, sell the put at $6.30. I'm selling that call at 29.40 roughly. Okay, I'm selling a 282.5 call at $29.40 synthetically. Short put, short stock equals short call. Okay, write that down. Short put, short stock equals short call. That's just an art. That's just put call parity. So I'm selling. I'm selling that call at $29.40, $6.30 against $6.10 the stock. Okay, I'm selling that at $29.40, and I'm buying this $3.31. We said at $4.70. So I'm selling it at $29.40 and $4.70. What's that? $24.70. I'm selling that call spread for $24.70. All right. I'm selling it's a 40, roughly a 49-point spread. I'm taking it $24.70. I got some juice here. Now, that's just selling. That's just doing that. Now, your risk there is a stock rallying. And that would dovetail into this. Is what why I would be careful doing this. Because I just think there's so much negativity around it. And I kind of think this, it just looks, get me out. This is pre-earnings, I believe. Pre-earnings. It's all over. Put skew blows up, and then they're wrong. And then then all of a sudden,
there have been 3 or 4 of those giving bears a lot of excitement, and then it blows up in their face.
Right. Big, hard freaking down. Look, I like to think I'm a pretty good short side trader. I like to think. I think right now, there's bulls, there's bears, and the pigs. Bulls, bears, pigs. Maybe I got everything out of this. How much more can I expect? Why couldn't it take out this low? Why couldn't it take out this low? I think shoulder, this thing is really not not perfect here, but I kind of think this is kind of bottoming. I'm nervous from the short side. I think that the 25 delta call against 25 delta put is compelling. I think you get a chance to, but I think you want to sell the stock at better prices now. I could be dead wrong, and the stock trades 280 tomorrow. I am wrong, but I would be. No one says I have to do anything. I want to look at. I think that this thing could trade right in here. This is what I'm looking at. This top of gap, if you will, 327. We'll call it 327 from from 823. I don't see why. You know what? If it gets there, I got the 316. I guess yesterday or 2 days ago, it bounced off violently. Yesterday, it handled 316 and came in a little bit. I think we get to 327, and then I think you look to put those spreads on. You got to realize if you're getting anything more than 7 clicks to sell that 25 delta put against the call, you're to the good. You'll probably still be getting it. Maybe you have new bears piling it. I don't know, but I think there's a good chance if this stock doesn't give the bears what it wants in the next couple of days, then it's a good chance trades 327.
Hey Tom, I'm getting a text message from a customer actually. I got it about 10 minutes ago. They asked you to clarify what is a click.
A click is one volatility point. A click is one volatility point. So if I'm looking at Tesla here, we're at 306, 305. I'm looking at regular way October. Let's go to it. Yeah, the 360 calls, 110 bid at 114.
Yeah,
they're trading at roughly, if you want to merge the two, 47.6 volatility, midpoint between bid IV, and the ask IV.
Right.
One click higher would be 48.6. One click lower would be 46.6. All I'm looking to do in a lot of these spreads is to try to fashion a directional bias or directional look, utilizing options, and fashion that look by leveraging technical and volatility metrics. Now, I think in the Facebook and the X examples I've given you, I think you got some compelling risk reward there. Low risk, perhaps some decent reward. 1x, 2x like that in unloved things, and you're able to finance it by selling the earnings related stuff, which should be high, no question. I don't dispute that. But you want to look. Let's look up there and let's use the technicals as another guidepost as to where the stock might go, and utilize those things. So click is volatility points. That's how I speak.
That's a good.
It's not kilometers. It's not kilometers, by the way. But go ahead.
No, that's a good explanation. Very good.
But that's essentially. I think Tesla. Look, do what you want to do. You want to sell stock here and put that spread on. Go right ahead. You'll probably win. I'm just afraid of what you're doing is you're essentially short that call spread. Which if the stock bounces.
What expiration do you have on the screen right now? I'm looking at the 350 calls are $1.80 to $1.90.
Yeah, I put up regular way October. What was the one I'm just trying to think. What do they have up there before?
No, so okay, so that's October 19th.
Yeah, that's 2 weeks from now. Okay, that's 2 weeks from now. You notice how the vol.
That's a long time in Elon Musk years.
Well, you want to go to this week? We'll go to this week. That's fine. All right. Hey, I mean, you can still get paid. The 25 Delta put is like $2.60. That's the 295s.
Where's the 330 calls expiring this week? Less than $1.
85 bid at 87, 86 cents.
Oh.
They're 85 bid at 87. Now the 25. Where were 320 calls. I mean,
and then where are the 270 puts or 280 puts? 280 puts this week. Yeah,
about 65 cents mid market. 65 cents. So I mean, the thing about I guess both of them would probably go out worthless. I would only caution. I don't know. I mean, I'm certainly aware of like, hey, 63 cents if it's a sale. I said, that's a nice piece of change to make. If I'm right by selling it, I don't know which way you're going, but I'm just putting out a risk reward type of thing. I think it's important for everyone to realize that a 60-cent option in a $300 stock is not like a 60-cent option in letter X.
Absolutely.
And you got to be aware of it. And look, what served me well is I'm not really good trading. Here I go. I'm not really good trading garbage options, the little ones, the babies. Some guys, and Larry knows them well. Some guys made livings doing that. That's not me. I'm not really good at trading in and around those things. So if I'm short something, like letter X is different being short something at 40 cents. It's a $30 stock. But right. Tesla, Apple, anything under $1, I'm short it. I'm buying it back. I don't think you want to be short it.
Well, that's exactly it. I was hinting at maybe different ways to finance, whether you have a bullish view or a bearish view, different ways you can help finance it. But exactly like you said, with this, I mean, you're one headline away from a $50 move. And, a 60 cent, to finance something for 60 cents just isn't worth it.
100% right, Mike. I mean, think about what you're right. I mean, it's like one of those cases. And I mean, you should speak about this too. Win out of the game. You know what I mean?
Well, also, no, I was saying if potentially, let's say you're long and your bias is long, maybe selling the 325 calls, just taking in, some money. But if it's 60 cents, it's, once again, still not worth it.
I mean, what would you want to sell? I mean, obviously, vols come down a lot in this thing, exactly. and rightfully so. I mean, I guess a lot of the news has come out. I mean, the 325 calls, the ones expiring this week, $1.30. It's still, I mean, you know what you're doing. I mean, and you're aware of this, and I think you should point out to the group is that you're long stock here, and you want you're selling the 325 call. I mean, what you're doing now is essentially you're short the 325 call. I mean, that's what it is. I mean, you can call what you want, but that's what it is. I don't know if $1.30 for the 3 days. I'd rather go out, Mike. To your point, I'd rather go out and where's the 325? I'd rather go out and take I'll sell it for $4 for 10 days. Go out a week. I want to get paid. I don't know if under $1 in this stock it just doesn't. That said, I'm going to be dead wrong. The stock will just sleepwalk here for the next 4 or 5 days. I fully understand that. But I think you're going the same point on that. Being short dollar stuff in here doesn't make a whole lot of sense.
Yeah, especially given the volatility and the recent, there's still probably a lot out there with headline bombs still to come.
Right. So I mean, so you're cognizant of the fact that there's headline risk, and it's got some historical stuff. But I mean, how I would play this. Let's wait, see if I'm right, see if the stock trades, 327 up in there, and then I think you put it on. Put it on and see if it still presents. If you're still getting that type of, if you're still getting this, 10 plus skew between the 25 Delta stuff and the this up here.
Yeah. So let's change the conversation. You've given us 40 minutes on the equity market, good risk reward opportunities in letter X, Facebook, Tesla, some different opportunities there, ways you're looking at. Let's go to the football field. What'd you see this weekend? What stood out?
I was having a great season till this week. I had Philly with a 14-point lead, laying a soft 3. Once they blow it. I had the Andrew Lucks at Pick'em down 28-10. Houston got a defense fall on the ball touchdown and a J.J. Watt strip sack of Luck at around the Indy 7 for one fall on the ball touchdown and 1 point blank touchdown. I'm down 28-10. Come back, somehow tie this thing, get it to overtime. Guy Marcus Johnson drops a 3rd and 2 at the Houston 18, where we had a chance to score a touchdown and win this thing. And then you know how it pans out. It's 4th and 4, their own 41, 27 seconds left. And I can't believe, first they try and hard count him, which I have no problem with. And then he goes for it, like one of the most moronic calls I've ever seen.
All right. Well, thanks a lot for the information.